S&P tried but failed to break through its 200-day moving average last week. However, our next guest says current market signals are more positive than negative now, and the next attempt should break through. Joining us now right here, Post 9's Bespoke Investment Group co-founder Paul Hickey. It's good to see you. Welcome back to the Exchange.
Thank you.
Why is the second time going to be the charm?
Well, I think there's a lot of angst in the market right now among investors of coming, we failed at the 200-day, and then we're coming into the Jackson Hole speech this Friday. And so everyone's, talking about this is going to be a big bad event. Looking at history, it says that you shouldn't focus too much on this. And anyways, I like to, the Fed, like economists and analysts, we're all in this experience right now where we have no idea what's going on and what's going to happen. And we're all going to make mistakes. It's like someone going off to college, learning, and you don't know what to do, but you want to rely on someone for info. So we're focusing on the Fed. Like we're focusing on Jay down the hall from D.C. or Esther upstairs from Kansas City or Jim from St. Louis. But the key is to listen to the market here. And I think what we saw in this rally off the lows was we saw very strong breadth in the market. We saw 90% of stocks trade above their 50-day moving average, which is historically 16 times it's happened in the past.
Since 1990, you
Going
say
back to 1990.
that 3 and 12 months later, the S&P was higher. 15 of those times.
15 of those times.
Furthermore, when less than 50% of the stocks were still below their 200-day moving average, the S&P 500 was higher 3, 6, and 12 months later, all 3 times, with, as you characterized it, massive returns.
Right. I mean, you look at the history, it was very strong. And if you that's 3 different periods of those 16. But if you widen it out to less than 2/3 of stocks above their 200-day moving average, it's still those same very consistent 3, 6, and 12 months later, higher every time. And sentiment has improved a little bit, but it's still very negative if you think about it. We still, the bull-bear ratio in investor sentiment, more negative than positive. It's now, close to the second longest streak of negative readings on record. And then you look at positioning in the Commitment of Traders report, it's the most negative it's been since October 2011. And I mean, it's a long time ago, but remember October 2011, that was a very good time for the markets before in that period. And it's just because we're in this environment where sentiment is washed out, there's very little faith in the market going forward.
Well, because there are too many wild cards, right? I mean, how can you expect there to be faith in anything where you have the wild cards of inflation and the Fed? And as you said at the very outset, no one has any idea where any of it's going, really. Right.
So the key, no one has any idea where it's going. But you listen to the message of the market, the collective wisdom of the market with this strong breath. And the wild cards is, I don't think there's ever a time that I remember in the past where the coast was clear. Everyone where I thought, oh, hey, the coast is clear, everything's looking like roses, and the market did well afterwards. I think the last time everyone thought things were going to go well was last November. And, look where we are now. So these headlines are negative right now, but the market was telling us that 6 months ago, and we, during that period. And I think looking forward, you're seeing this rebound in the market, and you're seeing this somewhat easing of credit conditions, still tight, but it's moving in the right direction.
You, of course, assume that there's no great mismatch between the market and the Fed. Now, today's action, not one day making a whole trend clear, but would seem to suggest that the market and the Fed are at least on the same page.
Yeah,
it's a matter of not getting grossly mismatched.
Right. I think that's a great point. You got to keep things in balance. And I think there is a balance here. We talk about, the Fed's going to keep hiking, 50 basis points, 50 basis points, 50 basis points through the rest of the year. But we all know that. So it's priced into the market. And when you heard Harker today talking about, and then maybe take a wait-and-see approach, the Fed doesn't always have to be hiking aggressively or cutting aggressively. You can just sit back and wait and see how things play out. That doing nothing is sometimes a good approach to take.
Yeah, and they've already been aggressive, as they would tell you, for certain. Thank you.
Good to be here.
That's
Thanks.
Paul Hickey, again with Bespoke, joining us here at Post 9 in overtime.